Welcome back. Okay, we're on the last part of Chapter 1, Business Transactions. Previously, we looked at the 4 different types of financial statements: income statement, statement of owner's equity, balance sheet, and the cash flow statement. And those are all things, informational items that we give external users. Well, how do we get the information into those financial statements? We record transactions, and now we're going to start off on the journey of figuring out how to record these transactions. In fact, a lot of what we're going to do over the next couple weeks and months is just do more and more analysis of how do we record different types of transactions. But we have to start somewhere, and so we're starting with the basic sort of fundamentals. Let's go ahead and take a look. Let's remind ourselves that there are six types of accounts. Now, underneath each of these accounts, there are a bunch of different individually named accounts, but these are the 6 categories. So there are assets, liabilities, owner's equity or just equity. There is revenue. There are expenses, and there are drawings or dividends. Every type of transaction we do can fit into one of these 6 categories. So what are assets? It could be land, it could be cash, it could be equipment. Liabilities could be bank loans, or if we haven't paid our employees yet, it could be some sort of wage payable. Equity, stock, that sort of thing. Revenue, well, this is what this is sales revenue, or maybe it's service revenue. Expenses, rent, utilities, all sorts of things. And then, of course, dividends, what we're giving to the owners, giving back to the owners. There's 2 main things that we have to know about business transactions. I guess maybe I should say 3. Think about it, I'll say 3 things. First, 1, we're going to use this, the accounting equation: assets equals liabilities plus equity. We're going to start off with the basic version and do a bunch of transactions to see how it works, and then we'll expand it a little bit. The second thing is there are at least 2 parts to every transaction. And this is one of the things that you need to start training yourself, is to think about what are the 2 parts. There's always a give and a take, and we'll do a bunch of different examples, so don't worry. There are always at least two parts to every transaction. And then last, after each transaction, the accounting equation, this assets equals liabilities plus equity, the accounting equation must balance. Now, both sides can go up, both sides can go down. One side could go up or down, but at the end, the different sides must balance. The accounting equation must balance after each transaction. So let's take a little bit of a look at some examples. Let's take some basic examples. So let's have assets equals liabilities plus equity. Just to remind ourselves, assets are things we own. We own land, we own inventory, equipment. Liabilities are things we owe. Think of this as also as obligations. And equity deals with what is the investment by the owners. Investment by owners. And in a way, it's what is their claim? What is their claim on the parts of the business? If you have one stock, you have less claim on the business than someone who owns 1,000 shares of stock. Let's start off with something very basic. I mentioned in the previous video that assets just don't come out of nowhere. They got to come from somewhere. So let's talk about a very basic type of loan. We're starting a business and we've got nothing. We have no assets, no liabilities, no equity. In fact, we, the owners, haven't even put any money into the business. Let's say we go right ahead and we get a bank loan. And I'm just going to use small numbers. These could be in thousands or hundreds, but let's just say $100 bank loan. Now, remember, we need to match it to the accounting equation, and there's two parts to every transaction, and the equation must balance after each transaction. Well, as we can see, if we got a bank loan, always start with something easy. I think a lot of times when students start to look at these different type of business transactions, they try to picture the whole transaction and then write it out on the accounting equation. And a lot of times, if you can't see all parts of it, you get stumped. So I would say always start with the simplest part, or start with a simple part and see if that then informs you or gives you a hint about what the other part might be. So most of the time, what happens with cash is kind of the easy beginning point. So if we got a bank loan, didn't cash go up by $100? Now, remember, the accounting equation must balance. Now, does it balance? No. One side is $100 more than the other side because it's nothing on this side. Well, if the company stopped today, if we took out the loan and we stopped, wouldn't we have to pay the $100 back to the bank? In other words, don't we have an obligation to the bank? So not only did we get $100 in cash, we also increased this obligation, this liability on the bank loan. So now you can see on the different sides of the equation, assets went up, but also our liabilities went up. In other words, cash didn't come from nowhere. It had to come from a bank loan. So we are obligated to pay that back. Let's take a little bit, let's say we do get some investment from an owner. So investment from an owner, we won't say issue stock yet. Let's just call it an investment. And let's say it's $200. Again, cash went up by $200. Start with the easy part. And what else? Well, again, right now we have $300 in cash. If we stop the company today, we'd pay $100 in cash back to the bank for the loan. And where would the $200 go? It'd go back to the owner because they would have a claim. They would have an investment claim of $200. So we say here, this is $200 in equity or owner's capital. So the equity went up. So we balance again. You notice this is $300 in cash, $100 in loan, $100 in liability, and $200 in equity. Let's keep going. Let's say we're a home builder, or we're some sort of builder where we use wood. Let's say we buy $50 worth of tiles. Well, what's happening? Start with the easy part. When we bought the tiles, did cash go up or down? Cash went down. Let me write this right. Cash went down. This is the down part. This is the amount in cash. Cash went down. Did a liability increase or decrease? Did equity? No. What ended up happening is we basically exchanged one asset for another asset. We exchanged $50 in cash for $50 in inventory, specifically tiles. Now, nothing happened on this side, and this side went down, then up, and so it essentially balanced. What does it look like now? If I were to draw a line, well, let me do one more transaction, and then, well, no, let me go ahead and do it now. So $300, so now we have $250 in cash, and we've got $50 in inventory. So this is $300 on this side, and we've got a $100 loan on this side, and a $200 equity on this side. So 300 equals 100 plus 200 equals 300. So our accounting equations still balance. And notice that there were still two parts to this transaction. The other thing to notice is sometimes it doesn't have to be something going up or down on both sides of the equation. It can be something that's going up and down on the same side of the transaction, and that still qualifies. The last one, let's keep adding to our knowledge of accounts and types of transactions. Again, we're a home builder. Let's say we buy $150 worth of wood, but we've been in business now for a little while, let's say, and we go to Home Depot and we've opened an account, meaning we go in, we get $150 in wood, and Home Depot says, you don't have to pay us right now, just pay us at the end of the month. What we call that buying something on account. We didn't use cash, but we still got the wood and we have to pay them later. So what did end up happening? Did cash change? Cash did not change, but we got another $150 worth of inventory, specifically wood in this case. And we need something to happen on this side. Well, just like when we took out a bank loan, weren't we obligated to pay them back later? When we took out this wood, when we bought this wood, aren't we obligated to pay Home Depot at the end of the month? So we have another liability here. And this particular type of liability is called an accounts payable. It's an account for cash that we have to pay later. And you may have heard the other type, which is an accounts receivable. We'll talk about that in a bit. So here, inventory went up, but also our liabilities went up. So at the end, I have $250 in cash, $200 in inventory, $250 in liabilities, and $200, and I end up balancing. So it'd be $250 cash, it'd be $200 in different types of inventory, I'd have $250 in liabilities, and $200 in equity. And so you can see this side is $450 and that side is $450. Okay, so up to this point though, remember we said that there were 6 types of accounts: assets, liabilities, equities, and then revenues, expenses, and drawings. Up to this point, we've taken the simplified view of just doing things with assets, liabilities, and equity. Let's add in revenues and expenses. So to remind ourselves, we want to, when we do the expanded accounting equation, let's add in this extra thing here. Let's remind ourselves about the financial statements. So the income statement is revenue minus expenses equals net income. The statement of owner's equity is the beginning capital plus new investments plus net income minus drawings equals ending capital. And that goes into the balance sheet as assets equals liabilities plus equity. This ending capital goes into equity. So if I were to just ask you, remember we just got through looking at assets, liabilities, and equity. We see how all of that's working. How do we figure out what are the effects of revenues and expenses and drawings? These 3. Well, let me just do a sort of a logic thought train. If revenues go up, all else being equal, net income goes up. If we don't change anything else and just increase net income, doesn't ending capital go up? And if ending capital doesn't, equity go up? So we could say assets equals liabilities plus owner's capital plus revenue, right? Plus revenue. Because as revenue goes up, so does the owner's capital. But what happens with expenses? When expenses go up, net income goes down. If net income goes down, owner's capital goes down, and therefore equity goes down. So as expenses go up, it reduces owner's capital. And by extension, think about as revenue is money coming into the company, potential profit. And who owns the profit? The owners. Expenses is money going out of the company, therefore kind of detracts or kind of reduces the profit. And drawings for a very different reason, but it's also cash leaving the company. So as cash leaves the company, that reduces the capital. So our extended, let me just flip the page here. Now I realize in the textbook, I think they put drawings first, but remember, assets equals liabilities plus owner equity. This is our original, and then these 3 are just taking in the effect of the income statement and the statement of owner's equity. All it's doing is tracking how do revenues and expenses and drawings actually affect equity, and that's what ends up being here. So let's just do two simple versions. I don't want to get too crazy in this because we're going to have a lot of opportunity to look at how revenues and expenses work. So let's just take a very simple thing and say, let's say we do a sale, and the sale that we sold it to the customer, the retail price is $100. But we sold them something. We have an inventory item. How much did we buy that inventory item? In other words, how much was it sitting in our inventory for? Or we could say the wholesale price, right? What we bought it for. Let's say we bought it for $40. Well, what's our profit there? Our profit's going to be 60, isn't it? So when all is said and done, we want the accounting equation to not only balance, but also reflect this reality that there should be an increase in profit of $60. So let's go ahead and do that. So when we sell it to the customer, $100, let's say we're selling it for cash. Cash went up, did it not? $100 in cash. And what else went up? Well, when we tracked it through here, we said when we make a sale, revenue increases equity. So we got $100 cash, but when we looked at the previous things, cash went up by $100 when we took out a bank loan as well. So just looking at this part, the $100 increase in cash doesn't tell us why. If we had taken out a bank loan, it would still be $100 increase here, but it would be a liability increase. But this particular $100 is because we had an increase in sales, an increase in revenue of $100. That's why we need both parts of this transaction. Just because an asset went up or down doesn't tell us enough information. We need to know why. Was it a bank loan or was it a customer sale? So here, in this case, it's a customer sale. Now we have a wholesale price of $40. Well, this was an inventory item, right? So inventory went down by $40. And why did it go down? Well, it's because we considered that an expense. In other words, we had to, in order to get $100 in cash, we had to give up a $40 item. And so it depends on, it's kind of a little bit wonky how they have it here, but you can either say it's an increase of expense that reduces revenue, but here, just to kind of keep things looking the right way, we'll say a $40 expense. So notice here, the inventory is an expense. If we were some sort of service related organization, let's say we had a lawyer and we would charge the customer $100 in cash, that'd be revenue. But perhaps instead let's say it's a lawyer, maybe it's $40 an hour for their services. So instead of being inventory, it might be some sort of wage expense. But it would be, we would pay the lawyer $40 and charge the customer $100. But we'd still have a revenue expense. So when we have a revenue and expense, if I then plug that into my income statement, if I go ahead and take all these things, it'd be 100 minus 40, and that should leave us with a $60 profit. Okay, I went a little over, sorry. This one took a little bit more time to talk about, but that should be the end of chapter 1. If you have any questions, please email me or see me during office hours. Good luck, and hopefully I've got all my recording equipment set up correctly now. It took a little bit of time, but I should be cranking these out every day or every other day. I should be up to speed now. Okay, thank you everyone, and talk to you soon.